All right, guys, I'll get started just because we have a lot to cover. My name is Armin Kalkash. We may have met before. Hopefully, you've attended some of my webinars earlier. I'm the founder of Revolology Analytics. We specialize exclusively on this sort of umbrella term called revenue growth analytics, where we build the enabling analytics foundations to help companies grow net revenues, margins, and customers. And so it's largely this area of sort of pricing analytics, margin analytics, customer analytics, right? That's what I've done most of my career. And so I'll tell you a little bit about myself. You can maybe see it on the screen. For those of you that don't know me, most of my career has been sort of at this intersection of revenue growth management and advanced analytics. I don't like to use the term data science. I like to use the term analytics for a reason. And so you can kind of see the background there. So I've done this sort of function, built teams and organizations that kind of do this stuff for different industries in CPG, distribution, and retail. And so it's really built a small business around my expertise. And in my free time, when I'm not doing engagements or where I'm where I have some free time in the evenings, I love to sort of create content. Along with tools, right, that hopefully practitioners find helpful and hopefully they can kind of implement in their organizations, right? And so, I definitely want all my content to be pragmatic. I want it to be sort of helpful for you guys. And what I would love to do is for you guys to be able to do some of this stuff in your own companies. So ask me any questions. There's a chat window and there's a Q&A session. But I'll get started. And so let me give you sort of a quick background on what we're talking about here. We've had a session maybe about a month ago on discussing an approach on how to build a margin analytics dashboard in a B2B environment, right? And so we'll actually go through an example today. Think of it as a minimal viable solution. It's built in Tableau. It's modeled after an engagement or a couple of engagements that we've done for medical devices and the distribution industry, but it's going to give you guys a glimpse of sort of the art of the possible stuff that you can build in your own companies literally within a couple of weeks, right? And so the reason I'm big in this whole area of building these capabilities organically is, I think historically, if you look at the industry and you look at sort of the company's thought processes, like we've assumed that building these analytics capabilities and these foundational efforts requires like huge budgets, right? Hundreds of thousands of dollars, millions of dollars, turnkey software, lots of IT involvement, and et cetera, right? And there's still some of that exists, but I think it's sort of a hurdle for many companies not to engage in this. And so I think, somewhat biasedly, right? I think this whole expensive turnkey software, right? It's broken, right? We live in an environment where, one, we can't wait that long to actually deploy these capabilities, especially capabilities that lets us measure the impact of pricing and how well our sales force is doing in terms of discount management or margin management and things like that, right? Like, especially in today's world, we're dealing with high inflation, but we're also dealing with an environment that's sort of celebrates democratized analytics, and we have all sorts of tools at our disposal, be it open source or be it some popular tech stack, right? Tableau, Power BI, even Excel, right? We can actually build these capabilities in a very sort of surgical and flexible way for companies, and very, very fast, right? We talked about inflation, right? Like hyperinflation in some countries, certainly a decent amount of inflation here in the US and most parts of Europe. But with that also comes lots of competition, customer choice, and things like that. So I think that's why companies, especially mid-market companies that are perhaps sort of tier 2, tier 3 of their industries, it's really important that they build these foundational efforts and they differentiate themselves from the competition. And so one of the reasons I encourage all of you guys to sort of explore this whole idea of building these capabilities in-house with your own tools, with your own data, as opposed to necessarily relying on sort of expensive turnkey solutions is, one, it's expensive. Two, it takes a long time to stand up. But three, it doesn't have the flexibility most often. In fact, about 80% of the time, these sort of enterprise turnkey software solutions fail, right? And that's sort of a measured empirical instance when you talk to companies. And sure, most of the time it fails because you don't have enough humans to actually sort of manage it and things like that. But it also talks about the lack of flexibility or the lack of purpose-built sort of software solutions. And so what we'll talk about today, we'll go through an example. It's built with Tableau off of transactional data. And again, it's something that you can probably port over to your companies and try to do it yourself. And you can reach out to me with questions and things like that. And I'm happy to help. But yeah, for the most part, if you work in a decent sized company, you will have a tech stack that looks something like this. You won't have all of this, but you'll have parts of this. And so with these sort of enablers, you can actually build margin analytics, promotional effectiveness, customer analytics solutions in a very sort of reasonable amount of time, as opposed to spending a lot of time and effort. So let's get started, guys. We'll actually post something up on the screen that will be sent out to all of you in an email. So you'll have access to this dashboard. You can download it. You can sort of upload your own company transactional data and play with it, right? And see what sort of insights you're getting. But let me just sort of paint the picture, right? So this is again an example that we've sort of done in medical devices and distribution. This is fictitious data. That's why I think some of the numbers and the trends may look funky to you. But it's really kind of meant to show you guys the art of the possible if you have some decent, well-structured transactional data, right? So we'll go through an example of this whole idea of measuring sort of the effectiveness of our pricing and our discounting efforts in our organization. It'll have several components that you see on the screen. Hopefully you can see it well enough. I'll try to enlarge it. But we'll talk about sort of discount and the interplay between discounts and net sales, right? And how well are we doing in terms of offering discounts to those customers that have higher annual purchase volumes versus those that don't, right? There ideally needs to be an inverse relationship there. We'll also evaluate how well is our sales team doing in terms of discounts and what is their collective behavior, right? Do they tend to always go up to a certain discount approval level that they can get from their skip level manager, or is there some sort of intention behind how they're managing pricing? We'll also talk about net revenue growth deep dive efforts, right? So this is an area that most companies actually don't get it quite right. Like a lot of companies do sort of high level price volume mix analysis. A lot of it is done at the brand level, maybe product group level, division level. And so those types of aggregate analyses hide a lot of truth and hide a lot of insight that you can actually take action on, right? So it's really important that you do this at a detailed transactional level. And that's what we've done here. And so you'll have the kind of the template and the approach of how to do this with your own data. Same thing with gross profit, really understanding how much of your gross profit growth, right, increase or decrease is driven by your pricing effectiveness, right? Your ability to generate more higher net price year over year for the same customer product grouping, right? Versus how much of it is cost inflation driving things down, or your ability to manage mix really effectively, right? Or volume, certainly, right? So again, we'll give you an example there. We'll talk about net price realization a little bit. It's slightly different than sort of price cost volume analysis. It's really about how much incremental revenue have you added this year through your pricing efforts, right? And so we'll dive deep into that. And we'll talk about, again, discount behavior, rep stack ranking, right? Stack ranking is typically a very sort of pragmatic way to measure performance. It's also a really good way to instill a sense of competition, and then sort of combining sales stories and anecdotes in a team environment with reviewing actual performance results, right? It's the combination of those two is typically really, really powerful. So let's dive in. This is sort of an executive dashboard that you'll see, right? I'm not going to kind of belabor the point here, but one thing that you'll notice right off the bat, all right, is we've selected a business unit that we're interested in evaluating. We want to know the performance of our commercial business unit. I think there's 3 business units maybe in this fake data, right? Commercial, farming, and passenger. We'll make up whatever company this is. Maybe it's automotive supply manufacturer or distributor, right? That seems appropriate. And so right off the bat, we can see 3 things, right? Net price realization. How well are we doing relative to our goals? We had a goal of increasing net price by 10% year over year. Super aggressive goal, right? How well have we done, right? We've actually said, oh, we need to have a price realization of 4.5 million year over year for this particular business unit. We were actually down 2.8 million. Maybe we decreased list prices, although hopefully that wasn't the case, or we gave more discounts, right? And again, this is done at the transactional level, so mix is sort of not influencing these numbers. But right off the bat, this allows us to see, well, the West region is the biggest culprit here, right? Negative 1.7 million decline in terms of net pricing, right? That was the contribution of the West region, right? Had we kept our net pricing the same, if our discount sort of mechanisms and behaviors were the same as it were last year, along with list prices, we would have been $2.8 million better off this year, right? Same thing on revenue growth deep dives, right? And by the way, if we set this up effectively, right, we can very easily change the timeframes and compare not just year to date, prior year versus year to date, but we can look at prior fiscal year versus year to date for price realization, right? It's appropriate to have apples and oranges in terms of the timeframes. But we can look at prior fiscal quarter or prior month, right? Just to get a sense of how we're trending in terms of our pricing power. On the revenue growth, notice a couple of things, right? Our net sales actually increased 12 million year over year. That's a really good story, right, for this particular business unit. Our pricing was actually down. Right? It was down 2.8 million. This negative 2.8 million is the same number that you see over here on the screen, right? So we decreased net pricing. We somewhat offset that by increasing our volume, right? So we sold more stuff. But look at the mix impact. And in particular, look at the mix impact in the South and the West regions, and we'll look at that a little bit later on, this is a positive $13 million number. So that typically means we've either sold there's four options, but things like selling a higher portion of higher priced items than what our overall portfolio is for this particular business unit, selling a lower portion of items that are lower priced relative to our overall portfolio. Like that's how you can actually influence net revenue through customer and product mix management, right? Because as we know, revenue management is more than just sort of explicit price execution and price management. A lot of it is also certainly volume, but also smart mix management, right? For those of you that may not have worked in pricing or may not be familiar with the concept, when we talk about revenue growth deep dive or gross profit growth deep dive, right, or decomposition, even though it's a trigger word, I shouldn't have used decomposition. So it's a deep dive. It's a growth deep dive. If you look at this net sales change, and maybe I'll enlarge it for you a little bit. If you look at this net sales change of $12 million, the price impact, volume impact, the mix impact will roughly add up to that number, right? It's about $11.9 million, right? And so what this does is it essentially takes the net sales increase or decrease, and it explains how much of it is driven by your pricing, volume, or mix actions, right? Same thing on the gross profit side. All we're doing here is we're introducing the impact of cost. And for now, the cost was sort of negligible or non-existent here, right? But again, same thing if you add a price, cost, volume, and mix impact, you'll be able to see the change in your gross profit. Okay, good. Executive summary. So if you're a director, VP, right, you've kind of looked at the numbers and you said, okay, we're doing great. Sales have increased. Our discounts have maybe increased a little bit, right? It's worse for some product categories than others. But let's actually dive a little bit deeper, right? Because some regions are doing really bad in terms of price realization. And some regions may be doing actually not so good in mix management, like the North Central region, you'll see that mix impact was actually negative, okay? That's when you can actually get into some additional analysis, right? So let's actually look at, we'll stick with the revenue growth drivers for now. So let's actually look at that real quick. And this is where we can really understand the details and further sort of dig deep into what's going on in our business, right? And again, this is a setup that you can very easily create for your own environment and your own companies. This is relatively agnostic to at least most industries like manufacturing and distribution. CPG and some other industries will have some nuances. Certainly, if you work in SaaS and whatnot, is gonna have some even more nuances around kind of price mix and cost impacts. But let's take a look at our commercial business unit, right? So notice right off the bat, we can easily select a business unit. We can select a subdivision, right? We can exclude or include certain customer segments. Same thing with our product segments. And for now, we'll look at year-to-date performance versus the same time frame last year. Okay, and so what do we see? We see that same $11.9 million increase in net sales. But we'll notice that the West region was particularly bad in terms of price impact, right? Negative 1.7 million. The South was particularly bad in volume impact. They sold less stuff, but the stuff that they did sell was actually higher priced. So let's actually take a look at the West region and see what's causing this negative price impact. So if you go to the right side, this is sort of a level 2 deep dive section. We'll focus on the West region, right? So we simply selected from the drop down, and let's actually look at get things by customer maybe, right? So if you click on this revenue drivers view, this will essentially create the deep dive at the level of sort of customer performance or whatever you want to select. And we'll look at the top or the bottom drivers, right? So the top 5 drivers are here along with the rest of them, and the bottom 5 drivers are here along with the rest of them. And so notice one thing right off the bat, customer 172 has a negative $1.17 million pricing impact, right? That's almost all of the adverse pricing impact for this particular region, right? So, okay, we can table that and see what's going on. What products are actually causing that, right? But just as easily, we can look at it by sales team member, right? And again, this is not meant to sort of chastise your sales team, but it's certainly an educational tool, right? Especially for them to understand the impact and relevance of their discounting efforts and their mix management, right? And so right off the bat, we'll notice it's actually a friend of mine. These are fake names, well, real names, but real names, real people, friends of mine, certainly not employees of any kind of real company that's included in this. But notice the big contributor to this was actually May, right? She actually decreased net pricing for her customers by negative $1.1 million, right? So if you want to have a conversation with May, you can quickly select her name. We'll go to this playground that actually gives us the detail of what it may do. And there's a lot of data on the screen, so don't get sort of bogged down by the details. Pay attention to only this pricing impact column, right? And notice that we have the same person here on the left side because we're looking at it by salesperson. That's how we sort of selected it. And we have product categories as sort of the next level of deep dive, but we can very easily kind of drill into subcategories and products and things like that. But for now, let's just keep it at a higher level, right? And so notice right off the bat, we see that 3 product categories, right? 12, 25, and 22 are actually responsible for all of the negative pricing impact, right? And so, right off the bat, that's a conversation that we can have with the sales team member on what happened to sort of pricing and discounting year over year, right? We also notice there's quite a bit of mix impact. And the mix impact is positive, and let's really understand why that is, right? So, if you look at maybe we'll take product category 12, right? The pricing impact was negative $700,000. That's a bad thing. We made up for it with selling more stuff, so our volume impact was almost $2 million, but our mix impact was also $1.1 million. So let's really understand why that is. If you look at this product category in our base period, right, which was year to date last year, the price of this product category, again, there's data underneath it, then we need to dig a little bit deeper, was about $10.50, right? The average price, the weighted average price for the portfolio that we're looking at, which is the West region in the commercial business unit, was about $8.30. So this was a higher priced item. Selling more stuff, or selling a higher proportion of this particular product category, will yield a positive mix impact on our net revenues, right? And that's exactly what happens. So if you look at the base period mix, which is the portion of our sales mix that this product category comprises, was about 15%. This year, it's about 23%. So we sold more stuff as a proportion of our total sales. That's going to have a positive mix impact because we're selling a higher portion of something that is higher priced than our portfolio overall. And it's a really important concept for companies to understand, especially their sales teams. And it's also really important to be intentional about measuring it and then sort of making adjustments through surgical sales and marketing efforts and things like that. Okay, so let's go back. We'll go back to our main screen, and maybe we can move on to gross profit deep dive. Okay, so very similar concept. We're now trying to explain why are gross profits up or down? What's really causing that, right? And again, we can do this in a very sort of easy, dynamic manner, right? We can select the, let's just stick with the commercial business unit for now. You'll notice that gross profit changed about $5 million. Great thing. Price was down $2.8 million. It was a $2.8 million impact to the gross profit. So our gross profit actually increased by $8 million, but we didn't manage pricing that effectively. And then mix impact was somewhat positive, right? But if we go to the right side and let's say we evaluate, again, we'll just stick with the West region and see what the trends are. If we look at the West region, you'll notice that there are some performers on the bottom, and we're looking at it by product family, where mix impact was actually negative. So product category 4 down at the bottom, we had a negative gross profit change of negative $850,000. We actually decreased net pricing year over year. Bad thing. Cost was negligible. And volume impact was also highly negative, right? But mix impact was positive. So maybe let's dive deep into this particular one, right? So we'll go here. We'll expand it. Maybe we'll look at subcategories of products and things like that. Let's really understand what's driving that crazy price impact. Well, notice this one particular subcategory. Think of it as a brand or sub-brand or whatever else, or however else you're kind of managing your product hierarchies. Price is actually up $140,000 year over year. So we've actually increased price. Notice about $4.45 per unit versus last year was $3.65. So that's a good thing. But another product subcategory, right? Product subcategory 4, we've actually decreased the price, right? And then again, there's many products underneath. So if we want to dive deeper, we can, because it's really built up from the transactional level. But we decreased price. So even the weighted average price for this subcategory decreased. And that actually had a negative pricing impact, right? Now, let's go back to the gross profit decomposition. In a similar manner, right? We can actually look at customer performance and really understand which customers are actually driving positive or negative gross profit changes, right? And so maybe we can zoom in on this one particular customer, right? So customer 15, gross profit was relatively unchanged year over year. Pricing was down, cost is negligible. Mix had a positive impact, right? So let's really understand why that is. So again, we'll look at the deep dive details, and then we'll immediately see, right, that pricing was really driven in an adverse manner, but 2 or 3 product categories, right? Most notably, product category 12. Mix impact was also down, right? But notice one thing: if you just kind of visually look at the colors, don't pay attention to the numbers and don't pay attention to the fact that there's so many columns. But if you just look at price, cost, volume, and mix impact, and you focus on red versus green, right, you'll immediately notice, oh, we've actually done something really, really good, right? So if you look at this product category 16 that's highlighted, that had a price point of $219 last year, right? It was a more premium product. In our overall portfolio, if you look at this, it was only about $4.40. So we tend to sell these smaller, sort of lower priced items, but occasionally we'll have maybe some other premium item, right, or something that's not a core component of our product mix, and we sell it at a much higher price point. And notice what happened, right? So in this particular business unit, and again, this is maybe looking at the Northeast as opposed to the West, we've actually sold a higher mix. It's not a huge sales mix, but we didn't sell anything hardly last year. And this year, we were actually 0.3% of our total sales mix on an item that is substantially higher gross profit per unit than our overall portfolio. So naturally, this will have a really, really strong impact on our gross profit generation, right? And so again, really sort of foundational concepts that companies need to understand, salespeople need to understand, finance, marketing needs to understand, right? And everybody sort of needs to be very intentional and concerted about managing not just net pricing, but also customer and product mix. Okay. So I'll go back and maybe we'll kind of switch topics a little bit, right? We'll talk about discount management, and this is a really sort of foundational technique that I think many companies use or have used. Certainly a lot of consultants kind of use this sort of view, but this is called the discount versus net sales matrix, right? And it's really all it's doing, it's mapping out net sales performance by customer, ideally on an annualized basis or maybe year to date. That's what you see on the x-axis here. And over here, you'll see the discount levels, right? So 30% discount, 50% discount, 70% discount. This is a really effective way to sort of look at the sales team performance in a particular region for a business unit, right? Let's just stick with the West region for now, and understand where do the customers fall in terms of discount levels, right? And ideally, what you would see, right, is you would sort of see this this diagonal line, right? Like, the larger the customers, the more they purchase from you, the higher their discount level is. And occasionally there's going to be these outliers. And so on the left side, what you see is a few outliers, right? There's maybe 3 or 4 customers that are above this upper threshold level, right? And it's set dynamically. So it's set by business unit and region. If you're a company that operates in multiple countries, you can set it by business unit and country. And why that distinction, right? A lot of the times there's sort of, inherent market dynamics and things like that that require maybe higher discounting versus lower discounting in some region than others, right? It's just typically the case in many industries, right? Like the Northeast and CPG distribution tends to be super price competitive, more discounts and things like that versus something like a Midwest, right? So that's why you really want to sort of control and isolate particular regions or particular countries. Okay. And so if you look at this, right, this is the upper threshold, this is the average. On the right side, a really simple, effective tool that pricing and finance or sales planning people can use is what if analysis. What would happen if we actually took these small customers and we just simply reduce the discounting to this upper threshold? What is the incremental impact to the business, right? And right over here on the right side, we see, well, the incremental impact is about $11,000, right? Not a whole lot. It's fictitious data, right? In reality, it's going to be a lot more. But we can easily look at some other region and see what those impacts are, right? And again, notice that these upper thresholds and the average lines will automatically adjust because we're now evaluating things within a context of a totally different sort of business segment and business region. Okay. All right. Let's see if Tableau is going to fail me or if it's actually going to go through. Looks like this is going to fail me. So let me just kind of revisit this real quick. If it doesn't work, I'll just move on to another section. Okay, let's look at the Northeast and see what the impact is. Perfect. In the Northeast, the impact is about $45,000, much more substantial, right? And we can play around with this, right? What would happen if we bring these guys to the average as opposed to the upper threshold? But look at that. The impact is much, much greater, right? It's about $350,000. Why is that? Well, it's because there's a couple of large customers, like this guy, customer 175, that Brian Anderson manages, and this customer 15 that Amy Windfall manages, right? That are above this average line, right? So in theory, right, if we're bringing them down to the average level, they're going to have a huge impact. And that's what you see here. If you close the gap 50% of the way, guess what? The impact is going to be automatically adjusted, right? And so, again, simple methods, especially if you apply price elasticities to the calculation, right? Which hopefully most of you know for your product portfolio and for your customers, right? You can make this a lot more surgical and a lot more relevant. Down below, and I'll show you this when we talk about this same setup for the sales team, right? You can just highlight some accounts, and I'll give you the details. Like, what is really driving this high discount for these small customers? Like, what are we doing? Like, what products, what brands are we selling at a super cheap price or we're giving away that causes these high discounts? And so, if you look at the bottom, right, you'll immediately notice, again, pay less attention to the actual numbers because it's a busy sort of a table. Pay attention to the colors, right? The darker the shade, the more impact it has, right? And if it's red, it's a bad impact. If it's green, it's sort of a positive impact. But notice right of the product category 13, right, has a really high customer discount, 60%. right? It's much greater than the average. It's certainly greater than the upper threshold. And there's a lot of units associated with that, right? It's 6,000 units, probably one of the highest sellers in the portfolio. But notice over here on the right side, and this is something that you guys should absolutely track for your companies if this is an accepted sales practice. We actually had some free product giveaways, right? And so if you look at customer 27, that also had a high discount. Product category 15 had a discount rate of 73%, right? And we've given away about $7,000 worth of product. And right, and maybe that's, I don't know, maybe that's like $5,000 more than what our actual guidelines are. Maybe our guidelines are set too aggressively, right? But typically, in many company environments, right, there's going to be lots of product giveaways, right? That's kind of an accepted practice in industries like medical devices, right? You tend to give away kind of smaller products to hopefully spur some additional purchase or some repeat business. But again, this is a really sort of easy way to evaluate where the customers that are driving very high sort of discounting efforts. They're actually eroding our net revenues or eroding our gross profits. And what is causing that, right? It's a really easy sort of peeling back the onion type analysis. Okay. We'll talk about discount curves, right? So as we've talked about what causes revenue increases or decreases, what is causing gross profit increases or decreases, talked about kind of discounts versus net sales, and to see if there's any imbalance and kind of offering deep discounts to customers that don't deserve it. Let's evaluate the sales team's overall discounting behavior, right? And again, very simple graph. Hopefully you guys can see this. Maybe we'll stick with the commercial business unit just on the off chance Tableau Online is unresponsive. But again, you can look at it by region, by state, by salesperson. You can filter out customer segments. But let's look at it year to date versus prior year. And so the way you interpret this, right? If you're maybe not used to sort of this view or haven't seen this before, it's a really simple sort of graph that looks at customer product level transactions, right? That have happened year to date and prior year. So this is prior year, this is year to date. And it buckets them, right? It buckets them in sort of various discount levels, right? And so it measures the units that have been sold at a particular discount level, and it maps out the cumulative units or the running percent of total units, right? And so this will add up to 100% of units. This is 0% units. And so as you look at this graph, right, notice a couple of things, right? One, we tend to have these increases at sort of 5% increments, right? So if you look at 20% discount, we have roughly 1.4 million units sold at that discount level. We've sold 37% of our total units at that discount level or lower, right? But notice this big kind of stair-step approach at 25%, at 30%, 40%, 45%, right? So what does it tell us? Our sales team, they tend to give discounts at 5% increments, right? It's convenient. It's sort of a standard kind of a discount increase maybe in the industry. But also notice another thing, right? If you just look at discounting behavior from last year, we have these huge increases going from a 20% discount, or sorry, like an 18-19% discount all the way to a 20% discount. Over here, we're sort of going from 48-49 to 50%, a huge increase in the number of units sold at these sort of round anchor discount levels. And again, another one at 70%. So come to find out, right? 70% happens to be the, let's make it up, senior VP's discount authority approval. 50% happens to be the VPs, and 20% happens to be the managers or the directors, right? So if I'm a sales rep and I'm closest to my direct manager, and I'm going to go to him most of the time, right? And the second sort of most frequent discounting approval effort will go to the VP and so forth, right? And that's exactly what we're seeing. And so what does that tell us? It tells us that we're using sort of little surgical behavior, very little intentionality, right? Not a lot of sort of insights, certainly not a lot of value-based selling, right? We just basically want to win the deal, and we anchor to the discounts that are part of the discount authority matrix or guidelines that I've established for the company, right? It's sort of a lazy behavior. And I don't mean that sort of in a belittling or dismissive way, but you see that all the time in companies, right? And I think this is a really good opportunity to coach teams, but then also kind of evaluate what is the impact, right? What is the impact if we reduce the discount guidelines for VP from 50% to 40%? Well, chances are, right, most of the efforts are not going to sort of anchor to this 40% discount level, and there's not going to be a whole lot of loss in business, right? The gain that you're going to have though is going to mean your operating profits and your gross profits and your net sales, right? So again, very simple but powerful analysis around evaluating the collective behavior of the sales team. Okay, we talked about revenue growth decomposition. We'll talk about gross profit growth deep dive. Let's maybe touch base on net price realization, and I'll show you sort of how these may look like for the sales team, right? Because all that we've talked about so far, it's really intended for revenue management teams, analytics teams, finance teams, right? They have a bit more complexity. You kind of have to understand data and analytics, and that has to be somewhat your world, right? For the sales team, you really want to keep things much simpler. And you don't want to overwhelm them with too much information, right? And so net price realization, right? That's what you see on the screen. These numbers, it's going to be the same thing as the pricing impact, but the percent impact is going to be calculated somewhat differently. So again, we're looking at commercial business unit, and we're looking at it by region, right? So again, the way we interpret these numbers is this is our net sales for the current period, year to date. In the West, we had $23 million. Our net price realization was negative 1.7 million. So we actually had a negative impact on our net sales results. What is that in terms of percent? It's negative 8.9%. So in plain English, our net revenues would have been 8.9% higher this year had we kept our pricing the same at the customer product level as we did last year, right? And so ideally, you want to see a step increase for companies year over year, right? Especially when there's an inflation, right? And so you'll immediately notice our goal this year for the West region was 1.9 million of sort of net price increase or net price realization. Some companies call it a price read-through or net price read-through, right? So it was 1.9 million, but we actually decreased about 1.7 million. That's bad. Why is that? Let's look at it. Let's look at it the West, and then maybe let's look at it by customer. See if there's any one particular customer that's sort of driving this really bad net price realization. So sure enough, right, if we look at customer 172 and customer 2, they're the biggest drivers. In fact, they're driving almost the entire thing, and maybe customer 173, right? And they're the ones that actually had the biggest sort of adverse price impact in our company. And again, very similar to what we've done in earlier screens. You can highlight one or more, right, and say, all right, let's actually see what's causing that, right? So what products are driving that? What product categories? And again, fake data, so you'll see a bunch of sort of lengthy product names. You can very easily kind of sort this and say, okay, it's really a handful of product groups and a handful of products that are actually driving this trend. So for example, product subcategory 4, we decreased the price by 50 cents, or sorry, about 20 cents. You look at product category 12, we decreased the price substantially, right? $1.50 or so, right? And so again, you can very easily see net price realization was negative 18%. And so this is a really easy tactical way to dig deep and understand what's causing sort of adverse impacts on your net revenues. Okay, we'll go back. We'll kind of continue the margin analytics effort, and we'll talk about maybe we talk about margin versus net sales, right? Very similar concept to our discount versus net sales matrix, right? Ideally, your smallest customers will have the highest margin percentage, right? Why? Because you're giving less discounts, right? Or maybe you're offering some different price tiers, right? So they have higher list price, and it's kind of an accepted practice for many industries, right? And your biggest customers will have the biggest discounts, right? Especially if it's a strategic customer. And so most often in companies, what you see though, is you don't see that trend, right? Customers tend to be all over the board in terms of discounts and margins, regardless of their size, right? And so it's a really sort of easy, pragmatic way to impact gross profits just by rationalizing that behavior, right? And taking a look at customers that maybe have low price sensitivity and they're small and they have, really high discounts and really low margins. Let's raise the price on them, right? I mean, if they're not that price sensitive, at least that's what kind of empirical analysis shows, it'll flow to our bottom line, right? So again, there's easy ways to make money for your companies by doing simple analysis. So similar concept, these bubbles are customers, right? You'll see the margin over here on the y-axis. It's a slightly different view, and there's a reason I sort of did this. This is a cumulative percent of net sales, right? So larger customers are going to be on the right side, smaller customers are going to be on the left side. But if you look at this horizontal line or this vertical line at 20%, to the right of this are customers that are driving 80% of your total sales, right? So it's a handful of customers that are driving 80% of your total sales. These other customers are only driving about 20% of your total sales, right? So why do these customers have such a low margin? Well, likely because we give them lots of discounts, right? Or maybe some of it is mixed. But the point is, we have an opportunity to actually raise these customers up to this lower threshold level that we can set, right? These are just simply percentiles. 25th percentile means that you have a margin level that's sort of lower than 75% of the other customers in this particular business unit and region, right? And so what happens if we raise these customers up to this red line? What is the impact? Well, the impact is about $32,000, right? Flowing directly into your operating profit, right? And if we close the gap halfway, right, it's going to be half of that, right? And so again, very similar to what we've done before, especially to sort of create an actionable narrative, right, for the sales team or maybe for your finance team. You can highlight it, you can look at the details and really understand, well, what's actually driving that? So notice there's a couple of product categories down below that have a negative margin, right? So we're actually selling them below cost, which is an issue, right? And then we can dig deeper, right? And we can drill down into the particular product and find out maybe there's one or two sets of products that we've habitually sold them below cost, and maybe it hasn't actually generated any sort of a sales increase year over year, right? Let's have a conversation about that. Okay. So again, similar concept as a discount versus net sales matrix. You're looking at it from a margin angle. And again, very similarly, you're quantifying the incremental impacts of sort of rationalizing some of this bad behavior. Okay. I'll go back and maybe I'll touch base on the next 10 minutes on maybe like for the sales team. What can we do for the sales team to actually spur some better behavior in terms of pricing and discount management? So we'll look at the same discount versus net sales matrix, but we're going to look at it for the sales team, right? And so we're not going to have any sort of scenario analysis, right? But visually, what we will show them is we'll show them the same thing, customers that are above this high discount threshold that we set. We set it at an 80 percentile, right? So 80th percentile just simply means your discount level is higher than 80% of the customers in this particular business unit and region, right? It's a really high discount. And again, small customers will have that. And notice if you highlight some of these customers, you'll see where they fall in sort of this axis of year-over-year net sales growth and year-over-year discount growth. Ideally, you want to be here on the lower right side, right? Your net sales are actually growing year-over-year. Your discounts are actually decreasing, right? It's not necessarily a bad spot to be in this area, right? So notice this customer increased by almost 100% in terms of net sales, and they increased their discounts by 26%, right? So maybe that's not a bad trade-off, right? But still, we can highlight some of these customers, right, and actually dig deep and find out, well, what's causing this. And so it's a really sort of simple mechanism for the sales team to understand, okay, let me understand what product categories are causing that. Let me understand how much I've sort of grown my discounts year over year, how much I've actually grown my net sales. And if there's a big imbalance between discount growth and net sales growth, that's a topic of conversation, right? Same thing with the free product giveaways. One sort of concept that I tend to use is this idea of discount strength index, right? And it's less apparent over here. And in fact, I think it's maybe an incorrect calculation for a grand total, but certainly at a very detailed level, and it's appropriate. The idea behind the discount strength index is within your portfolio, what is the share of sales, total sales, right, for a particular customer or product or customer product combination, right? What is their sales mix? Now, you repeat the same thing for discount dollars, right? What is their share of total discount dollars? You divide one by the other, and you get this index. And so ideally, your index should hover around that 100, right? Which means that you're sort of giving a proportionate amount of discounts for the level of sales that particular item generates. In practice, that's not the case, right? You're going to have items where you're giving it away for free or you're heavily discounting it. So this discount strength index, let's see if we can maybe find customers that have that. But this discount strength index will be much higher, right? 500, 1,000, and so forth, right? Here, we perhaps don't see that until we sort of expand it at the product level. So I'll leave it alone, but just again, conceptually, just recognize it's a really sort of simple calculation. It's pretty intuitive, and it's a good way for you to just visually see which areas of your business are receiving a disproportionately high or disproportionately lower level of discounts. Okay, so this is for the sales team. We'll get into revenue growth decomposition or revenue growth deep dive for the sales team. The thing that I tend to advocate here is really sort of illustrating this to a sales team member or a business development manager within the context of their own business, right? And again, maybe selfishly, I have my name selected, but that's fine. We can just keep it in my name. And so right, we have a salesperson here. And so what are we doing with the sales team is we're looking at their own business, and we're seeing what have they done this year versus last year, right? And so right off the bat, we'll see, well, I only have 3 customers. Let's see if I can select somebody else that has more customers. Okay, that's fine. So right off the bat, we can see that I've actually grown net sales by 1.4 million, right? My pricing impact was 0.2, my volume impact was 1.7. So I've increased net prices, good thing. I've sold more stuff, great. My mix impact was negative, right? And so it's really helpful for sales team members to understand why that is. And what was the impact of my net revenue generation? How does that translate to my bonus attainment, right? So if I would have been perhaps more intentional about managing my mix or focusing on selling higher priced items to customers, what would the impact been on my bonus attainment, which is really what sort of most sales team members care about, right? Down below, I reckon we're looking at maybe Brian Anderson, also a friend of mine. We can actually further understand what customers are driving those trends. So you notice this one particular customer has a huge net sales growth year over year, right, to the tune of $1.7 million. If I just highlight that particular customer, you notice the price impact was positive 200 grand, volume impact 1.7 million, and negative mix impact. And if you scroll down, this is where you can really have these conversations with sales team members to have them understand what's causing your negative pricing impact, what's causing your dilutive mix, right? Which items are actually responsible for that? So we can very easily see negative mix impact, if we just simply sort on that, is sort of driven by these really dark red areas, right? So product subcategory 514, whatever that product is, right? It's a negative $400,000 net revenue impact year over year, just because we've actually sold a slightly lower mix of a higher priced item, right? Higher price than our overall portfolio, right? And the same thing on pricing impact. So you notice that there's some dark sort of green areas like subcategory 520, where we've actually increased prices year over year, right? We've done a good job. Maybe we reduced discounts, maybe we passed on list price increases, but our pricing went from $7.80 to almost $10, right? It has a positive impact on our sales. And so again, simple sort of flow to help illustrate to sales team members how they're doing in terms of net sales generation. And by the way, they can easily rank customers by current period sales or base period sales or kind of their year-over-year sales changes, how they're doing in terms of sales generation and sales growth. How did they achieve that? Did they achieve that through smarter pricing, selling more stuff, managing mix better, and then really diving deep into selecting certain customers, understanding which products and services are actually driving those trends, okay? The last thing that I'll maybe show you for the sales team, again, really simple, sort of straightforward analysis around stack ranking, right? So You can do stack ranking for a variety of things. This is for discounts and sales. But right off the bat, you can see the sales team members for one particular business unit, right? You see all the names listed here. You see their current discount performance. This is, again, year to date, because we selected year to date as the current period. We could have selected some other time frame. You'll see how they've grown in terms of discounts year over year. And you see how they've grown in terms of net sales. And so there's going to be perhaps some areas like, well, me. I've done terrible. So I've actually grown my discounts 7% year over year. My current discount is the highest in the sales team. I've actually decreased sales by 43%, right? That's a terrible pairing to have when you actually invest in lower prices and you're getting a substantially lower sales volume. And so let's understand why, right? If I actually highlight my name, you can see the customer detail below, and we can very easily see which areas have had the biggest discount growth, right? And so again, the red things are bad and green things are good. So customer 204 is the biggest culprit, right? We'll see the discount growth has been substantial year over year, right? 17%, 14%, 6%, and so forth. And we noticed that net sales was actually way down, right? So they bought less stuff at a substantially lower price point, right? That is the worst combination you can have, right? So again, we would have a chat with Armin and kind of show these trends and really help him understand, like, okay, this is why your net revenue is down. This is why you're not maximizing your bonus. And so if you would have done these things, right, you would have a much better performance for not only for yourself, but also for the company, right? And so I think combining these elements, right, that I talked about in a holistic manner, right, evaluating discount performance for customers relative to their size, evaluating their margin profiles relative to their size, helping sales teams, but also finance, pricing, sort of peel back the onion on gross profit and sales performance into price, cost, volume, mix impact is really, really powerful. And I think it's a foundational thing that all companies should have, and it should be not real time, but near real time, updated, once a week, once a day, so you can actually address these shortcomings in your business real time. Okay, so guys, we're sort of at the time. I know many of you will have to sort of leave lunch and go back to work. But what I'll do is I'll send an email out either this weekend or Monday morning. You'll have access to this recording, even though it was mostly all of it was ad lib, which is typically how my webinars go. But you also have access to the content. So send out the dashboard, and you can play with it, right? You can easily kind of replace it with your own data and see what sort of insights and what sort of trends it sort of gives you. But I definitely encourage you guys to check it out, try to replicate it, try to play around with it, maybe use some other tools, Excel, Power BI, beyond Tableau, to try to actually build these capabilities for your companies, because a lot of these simple methods that I just talked about, they can have a huge, very substantial impact for your companies. So thank you very much for your time, guys. Enjoy the rest of the day, enjoy your weekend, and don't hesitate to reach out to me. Okay, thank you very much.